Hi everyone, so I'm Desi Rodriguez, aka Mr. Miami Real Estate, and I'm actually here today with Jorge Touzet. He's the owner of Syntax Mortgage here in Miami. So George has been doing this now for over 25 years. He's seen all the markets, the good and the bad, and he has stayed in business, which, says a lot about you. Congrats. And we're actually here to talk to you today about the basics of mortgages because honestly, it's the most important thing when you want to buy a home. It's the first place that you should start. So let's begin with the most important question that everybody has. What's the difference between a pre-approval and a pre-qualification?
The difference between a pre-approval and hello, Desi, how are you? Very nice to talk to you. Being here with Mr. Miami Real Estate, I'm honored.
Thank you.
So the difference between a pre-qualification and a pre-approval has all to do with a credit pool and document checking. So a pre-qualification is a conversation, and we can pretty much filter people pretty nicely with a 5-minute conversation, but that's not enough.
Right.
Pulling your credit, going over income docs, and checking everything is the way to get pre-approved. That's the difference. Is basically a credit check and document verification is the difference between a pre-qualification and a pre-approval.
Perfect.
Any agent showing homes, obviously, we suggest that you look for pre-approval.
Okay. So we've actually obviously sat through a lot of interviews together with clients, and I noticed that you always start the same exact way, which is starting with people's budget. So can you go into the process of why you do that and the importance of the budget when you're getting pre-qualified?
To me, budget is completely different from qualifying, and in most cases, a lot more important than qualifying. Budget, how many people didn't we see get in trouble in the old days because they bought something that they qualified for when in fact they were not budgeted for such payments, such mortgages.
Right.
I always start every single buyer interview, whether they be a first-time home buyer, an investor, or a second, third-time home buyer. I always start the conversation with a budget. Honestly, investments, you do not talk budget.
Right.
It's a owner-occupied conversation.
Yeah.
So once we complete a budget-oriented conversation, we get into qualifying to see if you qualify for your budget. Sometimes people end up qualifying for more than their budget. Sometimes people find themselves stretching to qualify for what they want to buy, which is
right.
It gets complicated.
But it's important just because we don't want them to, like you said before, to have a payment that's way too much and
Correct.
not be able to afford it later.
The most
not be able
important
to
thing
live
is
life.
right. The most important thing is someone's qualifications. Before someone's qualifications is keeping them in the home and making sure that they are comfortable with their payments, and it's all about responsible lending and making sure people stay in these homes.
Absolutely.
Definitely.
And then once we reach that budget, I know that budget is what ends up equating to what they're going to be buying in terms of a purchase price.
Correct. We have a really good streamlined conversation that we have with people. It's very quick. It's a 5-minute conversation, which gets us to the right mindset, understanding what home you're going to be looking for.
Perfect. And just so you guys know, just on a completely side note, when you're looking for homes online, a lot of times you do that before even speaking to a lender. Do not look at their estimated monthly payments. They are not accurate at all. They're going to assume that you're going to have either really cheap insurance, which you will not be able to find, or that you're putting 20% down with no mortgage insurance. There's a lot of assumptions in there that the calculations are not right. So obviously talk to a lender.
Definitely.
Okay. So let's get into what everybody's worried about, which is credit. So what is the minimum credit score that you need to buy a home?
Okay. Great question. So minimum credit scores really have to do with the type of loan product that we're applying for.
Okay.
And it's a very customized interview and process.
Mm-hmm.
For the minimum credit score to buy a home, I would say is a 580.
Okay.
Is what we would deem a score worthy of a low score.
Perfect.
It's 580. FHA is the product that would be used with that kind of score. If you're going to be getting into a conventional type product,
Mm-hmm.
The credit has a lot to do with the interest rate. They're very score-driven loan products.
Right.
And we suggest that you come into a conventional loan product with a 660 or more or higher credit.
Okay.
And even that is going to be
Pushing it a little bit.
pushing it a little bit.
Perfect. But so FHA, 580 is the minimum credit score. And let me ask you, we always have family members that are buying together, or we have a married couple, for example, and the spouses. one person has good credit and the other doesn't. So can someone with good credit and no income be added to help somebody out with bad credit to a loan?
Desi, no. That is not going to help. We are going to go off of the lower of the two scores.
Right.
We're going to use the middle score and the lower of the two. So we're always going to go off of the lower score.
Okay.
And there should be some income weight on any co-borrower.
Right.
So
it won't happen.
It won't happen. And something I'd like to add is, one of the things that we like to do for consumers is, it's part of our service, is a credit analysis and a rapid rescore process.
Right.
If your credit isn't there, and we don't call this credit repair, we don't charge you for this. Part of our process is helping people get their score where it needs to be, so they can get the best terms and best loan products.
Perfect. So let me ask you, a lot of people think that they're perfect and they're good to go because they're using online services such as Credit Karma. They see that they have a 720. Would you say that's accurate in your experience? Should they come in and pull their credit anyways?
Credit Karma, the difference between Credit Karma and these consumer-sided credit systems, we use a factual system. It's a completely different model, different score. We see them sometimes our scores come in higher or lower than these consumer models. Definitely a real credit check with a factual system is the way to go. We don't pull credit right off the bat. We make sure that everything else works before we go ahead and pull someone's credit. So if you come in with your Credit Karma on hand, we're going to take a look at it and we're going to use it to make some type of assumption, but in the end we will pull your factual credit.
Perfect. And what happens with someone that doesn't really use credit, or someone that only has like one credit card? Is there a minimal credit history that's needed, or?
FHA does ask for, and I talk about FHA because it is the minimum threshold.
Right.
So FHA does ask for 2 trade lines.
Okay.
And young credit is very acceptable, though. I mean, we've done loans for FHA consumers with, a short 24-month credit history.
Perfect.
So yeah, FHA is very flexible when it comes to short credit history.
Perfect. And this is the question that everybody has, and I know a lot of people get worried. People run into tough times. Collections accounts stay in your credit for a long time. So if somebody has collections accounts from 3-4 years, for example, are they going to have to pay all of that debt in order to qualify?
I've seen a lot of people preemptively go out and pay for, coffee's great, by the way.
Thank you.
I've seen a lot of consumers preemptively on their own go out and pay off a lot of debt unnecessarily.
Right.
And they end up with no money to buy. My suggestion is don't touch anything. Come sit with a professional so that they can assess you first, because you may not need to pay all those collections. Collections that we're going to be looking for are anything that's non-medical and above $2,000. If it's below $2,000 non-medical, you're going to have to, if it's above $2,000 non-medical, you're going to have to pay it off, or we will apply a rule that will basically affect your debt-to-income ratio.
Perfect.
Most of the times, we don't see a lot of problems with that. We can get past it. Just don't pay off debt without speaking to a professional, because you may be throwing money away.
Okay, and here's the other one. Okay, people have bad credit, and I know you touched on it a little bit, but just what is the best way? What should somebody do when they have bad credit?
So, bad credit is there's no measurement there. A lot of people come in and say I have really bad credit, and when they leave here, they're ready to buy.
Right.
Bad credit is something that's it's hard to measure what bad credit is. If you have troubled credit, it's a very customized interview. We go over some items, and whatever needs to be taken care of, you will know it when you leave the interview.
Perfect.
It's a very customized question.
And let me ask you, there's a lot of people, obviously, especially here in South Florida, the credit repair companies are on every corner. What's your opinion of people who go to credit repair companies before coming to you just so that they get items off? Is that helpful? Should they do that, or should they not?
It becomes troublesome. Sometimes a lot of, unnecessarily spending, consumers end up spending money unnecessarily.
Right.
Credit repair, for the most part, relies on deletes of accounts, and deletes of accounts are associated with disputes. Disputes are not acceptable when you're going to buy a home. You should have no disputes, open disputes, when you apply for a mortgage. If you do have open disputes, we will ask that you close them, which in turn might affect your score negatively. So anything you would have done in the past to bring the score up with disputes might be, rolled back
Right.
as soon as you sit with us. Disputes is not the way to go. So I don't recommend that anyone goes straight to credit repair before they sit with a professional. Sit with a loan professional
Perfect.
before you do any credit repair. Save some money.
Okay, so let's say you recommend them to somebody wants to buy a home now, especially that interest rates are so low. They come in, they have to make a few movements on their credit. Do they need to wait months for their credit to update, or is that something that you can help with?
So our credit analysis interviews, which is part of our pre-approval process, it's for the most part, it usually takes 2-3 days to complete.
Mm-hmm.
I'm going to give you some instructions. Usually, it's a reduction of revolving debt is
Okay.
usually what does it. Sometimes, you may have gotten added to a family member's authorized account on a
Right.
credit card. Those things really help credit. There's a lot of ways to go about it, and most of the things that we put on the table are things that are quickly achieved.
Perfect. And then I also believe that you have a product, I've seen you done it before, which is the Rapid Rescore.
The rapid rescore is basically it's an acceleration of something that'll happen naturally to your credit report
Right.
within a 60-day period. The rapid rescore allows us to get that placed on your credit a lot sooner,
Perfect.
usually 2-3 days. There is a cost associated with it, but minimal compared to credit repair.
Right. Perfect. Okay, so I think that's everything for credit. So let's talk about the qualification process, and that's usually determined, as you mentioned earlier, by the debt to income ratio, where you just look at what someone owes and how much they make.
Sure.
So what debts are used when calculating a person's debt?
So the debts that we are using to calculate debt to income ratios
Mm-hmm.
are any car loans, leases, or installments,
Okay.
credit card debt, personal loans, student loans, and in some cases, things like timeshares and other debt that you might have that shows up on your credit.
Perfect.
We don't pay attention to any utilities, any light bills, water bills, cable bills.
So-
That does not come into
Perfect.
calculation.
So that was actually, you're ahead of the ball. That was actually my next question. Would you ever look at any outside bills for any reason?
No, we don't look at outside bills. There's something called underwriter discretion.
Mm-hmm.
If we see something that's consistently coming out of your credit, out of your bank account,
Mm-hmm.
when we see your bank statements, those things might come up. Child support, alimony, those are definitely debts that we pay attention to.
Perfect.
There's a few more things that we go and get into with interviewing,
Okay.
but we're very precise with interviews so that things don't fall apart at the end. We look for debts that are not typical. We ask the right questions.
Perfect. And let me ask you, is there any debts that can be ignored or omitted from the calculation?
There's rules associated with installment loans, car loans, that type of lending. If there's less than 10 payments to go on an installment loan,
Mm-hmm.
if less than 10 payments, we can omit them from your application.
Okay.
We can ignore them.
And by car installment loan, you mean if they've purchased a vehicle, not a lease, correct?
Yes, this only works with purchase if it's an installment loan,
Right.
not any vehicle leases or definitely installment loans, no revolving accounts either.
Perfect. Okay, so here's the most popular question that we get all the time, especially in South Florida. It applies here every single day. What happens if somebody's co-signed for a boat, a car, student loans, and they are not the person making the payments? They just helped out a family member, a friend.
Sure.
How does that debt get treated? Because it's on their credit report.
Sure. So long as both parties are on that application, so long as they both sign for the debt,
Mm-hmm.
and the non-mortgage applying consumer is the one making payments from their own checking account, disassociated from anything having to do with our borrower,
Mm-hmm.
we can omit that debt.
Perfect.
It has to be ongoing for 12 months or more,
Okay.
and it can then be omitted. We have a situation sometimes where consumers are co-signing on a car for 6 months,
Mm-hmm.
but the car that was previously owned by them was also same situation co-signed. So we can roll back into previous cars
Perfect.
to complete. I'm not if I confused you with that, but
No. Made complete sense. So basically, guys, if you have a bunch of debt on your credit report because you co-signed for a boat and a car and you're not the one making the payment, we may be able to omit it. Very important, because a lot of people get scared with that.
definitely there's a flip side to that as well. You have the consumers who put a contract on their new house with a big backyard and a big side entry, and they decide to go buy a boat a little early. So don't buy your boats before you close on your house.
Yeah.
You might end up sleeping in the boat. Be careful.
Very important. Okay, so I know that you touched on it, but child support and alimony, obviously that usually doesn't typically pop up on your credit, but it is something that you need to include and that consumers need to disclose to you.
Sure. It's part of our interview process, whether it be a debt having to do with the alimony or child support. Sometimes it's income having to do with child support or alimony. We bring it up on both sides.
Perfect.
And it's definitely a debt that we have to look at. If the debt is not showing up on credit, typically it doesn't. We look for it in other ways. We find it in pay stubs. We find actual deductions for child support coming out of pay stubs. And there's other ways that we bump into it. So definitely it becomes part of the interview early. So
and make sure to disclose it.
Correct.
Yeah, perfect. So let's go into income. And I'm going to ask you the most common question, which is, do I have to be at the same job for 2 years in order to qualify?
Not necessarily, Desi. Not necessarily.
Perfect.
The completion of a 24-month work history can be achieved in a lot of different ways. A lot of times schooling helps us complete that 24 months.
Okay.
There's situations where there's gaps that interrupt that 24 months. We simply explain them if they're short enough.
Okay.
So there's a lot of ways to go about getting people into a home if they just got into a job. We deal with buyers all the time that just got a new job, a nice new job, and they want to treat themselves to a new house.
Okay.
And there's nothing wrong with that. We can achieve that.
Okay, and then in South Florida, obviously, there's all kinds of different payment structures. So you have the people that make a lot of money or most of their money from bonuses, overtime. They are in a part salaried, part commission job, and they make a lot of the money from commissions. How does that affect their qualification? How does that extra income get added usually?
So that extra income, anything above base pay having to do with or associated with bonus, commission, or overtime has to be ongoing for 24 months. We will average that extra income.
Okay.
If your income is more than 25% of your income is commission or bonus, then we got to average the whole thing.
Perfect.
So there's definitely rules behind that. Okay. Sometimes they help us. Sometimes we got to wait a little bit, but we'll make sure that we use all the income we can so that you qualify for the house you want.
Perfect. And you're actually super ahead. You could tell you've been doing this for too long. So the next question was actually, can you count income for child support or alimony? But you answered that we actually can. So if you do receive child support or
so
alimony,
long as it's ongoing for I'm sorry to interrupt you.
Yeah.
So long as it's ongoing for the following 3 years.
Okay.
So if the child's 15, you got and we have 3 years continuity, then we can use the income. If not, then you got to ignore it.
Perfect. And then this is actually one of my favorite questions because I'm actually a broker that recommends you guys when you're selling a home and you're gonna buy it or you're getting out of a home to get into another one. I personally usually recommend in a lot of situations to rent the house instead of selling it. I think it's a better thing for people to have a portfolio and to have rental properties. So how does that work if somebody owns a home and they want to rent it and not sell it? Can they use that income to qualify, or they're going to have the old mortgage holding against them?
In some cases, we can use income from a departing primary.
Okay.
In some cases, we can't. There's rules associated with it.
Okay.
And we go through the right process to get to the answers. For the most part, if you're buying using an FHA loan, you won't be able to use departing primary income. There's some pretty deep-rooted rules with that with FHA. But for conventional loans, for the most part, you can use departing primary income from a property that you're going to be renting out and when you buy your new one.
Perfect. And usually
it can help you.
And usually, I mean, I would like your opinion on this because I always tell people if you can do it, you should do it, especially if you don't need to take the money out of the departing property to qualify for the next one. Would you recommend them to rent out the property? Would you recommend them to sell? Do you have an opinion on that?
Acquiring a property, especially when there's a loan involved, is not a simple process. It's a cumbersome. It takes work. It's not easy to buy a property. So if you achieved one, try to keep it.
Right.
There are some cases where funds are necessary to buy your next home, and you got to sell.
Absolutely.
In those cases, then definitely there's so many other instances where sales are necessary. And when that takes place, call Mr. Miami Real Estate.
I'll take good care of
He
you
knows
guys.
what he's doing.
So obviously we actually see a lot of this. We have nurses, doctors, accountants, they just graduated school and they're obviously getting into their career and making a lot of money. Do they need to wait to have that 2-year history? Can we apply some of their schooling
Definitely
as a background? How does that work?
Schooling is professionals are well taken care of.
Okay.
Their schooling will become part of their 24-month history. So if you just got your nursing job as of 2 months ago,
Mm-hmm.
we can definitely use that income.
Okay.
And you definitely can qualify using whatever income we derive from that. The number one thing we got to look for with new jobs and home buyers is contracts, employment contracts,
Mm-hmm.
and 90-day probation periods.
Okay.
They have to be past their 90-day probation period
Perfect.
in order to close.
Perfect. And this is actually one of my favorite ones. We've actually had, a few people come in and they're a little bit short on their qualification. So they want to be able to qualify for a little bit more, but they just don't meet the threshold.
Mm-hmm.
And we've actually helped people get raises and recommend them to go get a raise, whether to their salary or
Why not?
their hourly
Yeah,
wage.
definitely. We've seen that happen.
So is that something that they can use if they go, they ask their boss for a raise and they get it, which if you're buying a house, it's a good time to ask, by the way. So can they use that right away?
Yes,
Or do
right
they
away.
have to wait?
As soon as I can get it's going to show up on a verification of employment, which is a written document
Okay.
form that's sent over to the employer. And if the employer mentions that you just got a raise, we can use that right away.
Perfect.
It's actually something that has happened to us on a couple of occasions,
Yeah.
where we simply recommend to the consumer, go to your employer, tell them you're buying a house, and ask if you can get a raise.
Yeah.
They're not all going to say yes, but
It's happened.
It's happened.
It's happened, and I love it because not only do we help you buy a house, but you're making more money in the process. So it's one of my favorite things. And I'm going to finish the income with this one, actually. And I just want to say I want you to go into it very briefly because we already discussed doing a full video, and you guys should check that out. But how is income determined for self-employed people? Because everybody's an entrepreneur in South Florida. It's
Sure.
very common. So how does that work? And again, very briefly.
Sure. So self-employed individuals, for the most part, we average their income for 2 years.
Okay.
And there's a big misconception regarding W-2s and 1099s. You can be self-employed and get W-2s and receive W-2
Okay.
deduction. It isn't necessarily only 1099 individuals that are self-employed.
Okay.
So there's a lot of different variations of self-employed individuals.
Okay.
And it's got to be brief because we can really go down that wormhole.
And that's why we're doing the entire video for it.
Correct. So, but yeah, for the most part, a 2-year average
Mm-hmm.
is the way to approach a self-employed individual.
Perfect.
That's
So they would have to be in the same line of work for the 2 years.
correct. That's
Okay.
typically the way we look at it.
Perfect.
There's some exceptions and things we sometimes run across that we can use the income. It's atypical.
So we'll get into it in the
Yeah.
video, guys.
Self-employed people are complex.
Yeah. So if you're watching this and you're self-employed or you're thinking about going self-employed, if any of it applies to you, be sure to go check out that video because it's gonna be up soon and it's something you want to see. So let's get to the important part, which is money. Everybody wants to talk money. So what is the minimum down payment and different loan types to make this possible?
Sure. So when we talk first-time homebuyer products, we think of low down payments. The truth is these type of loan products are not just for first-time home buyers. You can literally be on your second, third home
Mm-hmm.
and use a conventional 3% down, 5% down loan product.
Okay.
We associate low down payment products with 5% down conventional,
Okay.
Fannie Mae's Home Ready, which is 3% down,
Okay.
and FHA, which is 3.5% down. Those are the 3 loan products that we consider low down payment.
Perfect.
And so there is your VA, which VA's is 100% financing. There's no money down. That's
Which VAs apply strictly for veterans. It's a veterans
correct.
loan.
Only our veterans. We have a nice program for them. There's no mortgage insurance and there is no down payment. So they buy a lot of house with their loan. So 3% down would be the lowest down payment product, and that would be a Fannie Mae Home Ready.
Perfect.
It is income limited. So if you give us a call, we'll give you a quick snapshot of what we can do.
Perfect. And man, I just gotta say, there's a million memes out there that say buy a $400,000 house, you only need $12,000. I hate all of those just because obviously there's other costs besides the down payment that go into a loan. So what are closing costs?
Sure. So let's refer to it better. Let's refer to it as cash to close.
Okay.
Cash to close is composed of three components.
Mm-hmm.
There's your down payment, which is dependent on the loan product you're going to be using,
Right.
3%, 3.5%, or 5%.
Mm-hmm.
And then there's closing cost. Closing costs can range from anywhere from 1.5% to 2.5% of your loan amount. And then you have your prepaids and reserves. This is your insurance paid for a full year, and an escrow account that's set up
Perfect.
at closing. They're going to typically set you up for probably 3 months worth of tax reserves and 3 months worth of insurance reserves. So those three components, down payment, closing cost, and prepaids and reserves, are what make up cash to close.
Okay, perfect. And usually when someone comes in and they talk to you, you go through the budget, you realize what amount of property they're gonna buy, whether it's a $400,000 or $500,000 house. And when we reach that point, you obviously discuss the cash to close right then and there to give them an estimate, correct? Okay.
We go from a budget talk into identifying the type of house price range that we're going to be looking at.
Mm-hmm.
And from there, we go right into a cash to close conversation
Perfect.
to see if things are working out for the buyer. And if the conversation goes well, we go right into the full pre-approval.
Perfect. And guys, just so you know, I'm going to mention this briefly. So if you are a few $1,000s away from the amount of money that you need to be at, let's say you need $30,000 and you're $4,000 or $5,000 short, you do not have to wait. You don't have to wait another 6 months, a year, however long it'll take you to save up that money. There is something called the seller contribution that we can get for you guys, which can help you with your closing costs and your down payment. I'm not going to fully go into how that works just because we also have another video just on that topic, so be sure to check that out as well. So we run into this a lot too, which is where the money's coming from. So we've had situations where obviously you're doing the pre-qualification and they tell you, yeah, I have the money, and then you see the bank statements and there's not a lot of money in there, and they tell you, no, I have the $50,000 sitting under my mattress. So what happens? Where's money acceptable where it comes from?
So source of funds for down payment and closing costs are one of the big things that we come across that we need to solve. A lot of times, money is sitting in places where we can't verify it properly. We have to, source the money properly. You can't just get money cash and throw it in your bank and buy a house with it. There has to be some sort of explanation as to where that money came from. So if you have money sitting under your mattress because you feel it's safer there, start pulling it out little by little, and
which it's not, by the way, but
yeah, not wise to keep money under the mattress.
Yeah.
But definitely source of funds and where money comes from is a big deal. A lot of times gifts are a good way of sourcing funds. There's people sometimes sell cars. They deposit their money in the account. We got to explain what it is.
Perfect.
So there's a lot of variations of
so you need a paper
money.
trail.
Got a paper trail where the money came from.
Perfect.
You can't just grab money and throw it in your account.
Perfect.
And we'll get into that. It's very custom, very personalized.
So let's say somebody has stocks, for example, because it's very common. Maybe not right now with everything happening, but can you liquidate part of your portfolio in order to get the funds to buy a house?
Sure. Stocks are definitely a usable source of funds.
Okay.
You have to liquidate them in order to use them.
Right.
If you're even for reserves, they have to be liquid.
Perfect.
401ks are a good source.
So that was actually my next question, which was, can you take out money from 401ks or any retirement accounts?
Definitely, you can take out a percentage of your 401k. It's acceptable.
Okay.
In order to buy your home.
Okay.
There's tax breaks and other things that you want to look into when you're
so
when you're going to be
definitely
using a 401k.
that's something to talk to your
If you have a
accountant
401k, you can go online and pull your terms and conditions of withdrawal, and it'll give you a lot of details.
Perfect.
If you're looking to buy a house, that's where you're going to find some good information.
And I had to throw this one in there because it's actually been asked several times and people online wanted to know, can you take out a personal loan for your down payment?
No, you cannot use borrowed funds for down payment money.
Okay.
It has to be funds that are gifted or earned.
Perfect. And so we've made it through the entire qualification process, and now it's time to go home hunting, which is looking for homes. So how does, when you're purchasing a home, and it's usually different whether it's a condo or a house, so how does that really affect the loan?
So when you're home hunting, property type is definitely a important subject matter. Typically, low down payment loan products, first time home buyer products, don't work well with condos.
Right.
So you want to try to stick with lot and block properties when you're doing anything having to do with 3%, 3.5%, or 5% down. Once you get into condos, you want to start looking at other loan products. We do have a nice suite of loan products for condominiums. 10% down, I'd say, is the sweet spot.
Okay.
Where you can work yourself into a condo. There are some score requirements and debt to income requirements with the 10% down program.
Right.
It's a limited review product, Fannie Mae, and we have nice products for loan for condos. But yes, condos are complex. It's another custom conversation to have with someone.
And let's say they won't qualify for the 10% down. What would be the minimum down payment for a condo?
So minimum down payment for a condo is 20% down.
Right.
For a 20% down Fannie Mae loan product, you're going to need a full review of the building. It's typically buildings in South Florida typically don't pass that full review.
Right.
So going limited review is the way to go.
Okay. Limited
review requires 25% down.
Okay.
If your score is 680 or higher, and your debt to income is below 45%, you can actually do a 10% loan product that we have. It's a Fannie Mae product. It's a combination loan.
Perfect.
And I'd love to offer it to anyone looking to buy a condo. I'd say the best product out there for condo.
Perfect. And I just wanted to go back and clarify really quickly. You mentioned that usually the low down payment products are for lot and block properties. For all of you that may not know, what that means is basically that your single family homes and certain townhomes would fall into that category.
Yeah.
So this is the question where people get confused all the time. You have two homes in the same exact neighborhood. They're both selling for the same exact price. For example, you have two homes on one street that are both $500,000, but the payment can be even hundreds of dollars apart. So can you explain what goes into the mortgage payment and why that amount may vary on two homes that are the same price?
Sure. So one of the biggest variance in a home loan payment is the property taxes. You can literally have two properties sitting next to each other, same exact home, with completely different taxes.
Right.
It may have to do with when a house was purchased and at what price.
Right.
The millages for different areas vary. Two houses next to each other will have same millages, but they might have completely different situations regarding last sale history.
Right. One might be a homestead exemption, which is owner occupied.
Correct.
One might be an investor property.
And for the most part, taxes do tend to change or have an effect when a purchase takes place.
Right.
You're usually going to see a tax change. So those are also things that we analyze when we sit with buyers. We don't want people getting into trouble in the future.
Right.
So we like to have home buyers understand what could happen with their property taxes after their sale takes place.
And what else would vary in a loan?
So another thing that varies highly, you can have two houses, just like you said, door to door, and the payment can be completely different. Obviously, down payment amounts. But for people who are giving less than 20% down, another big variant is the private mortgage insurance, the PMI.
Okay.
These mortgage insurance policies for conventional loans are dependent on score. So you can have two completely different homes, two completely different home buyers, different mortgage insurance payments, all based on credit score.
Okay.
So.
And how does insurance play a role? Insurance is typically different for the properties as well, correct?
That really is. They shouldn't be that different if you have two homes sitting next to each other.
Right.
It all has to do with what kind of insurance break you get from your favorite agent.
Right.
Definitely shop the insurance amount, because there's a lot of variations with insurance prices.
And I'll tell you guys, one of the common things that you could look at when you're looking at homes and you're trying to determine whether your insurance is going to be really expensive or not, or the main components, if the house is remodeled, it has a new roof, and it has impact windows or the accordion shutters, typically you're going to get an insurance break on that and a discount, so you can expect a lower premium. So just when you go into the house, I would definitely recommend looking at those little details. So we found the house. We negotiated with the seller. We reached an agreement. We have a signed contract. What happens now, and how long does it take before the whole process is finished? What's the typical time frame?
So typical time frames for entering into a home loan application once you find your home really depends a lot on how we work together with a consumer to get the documents we need to submit the loan. Most of the time, all it requires at the point where you find the home you love and you got a contract on, is to update some information that we may already have on file. That information can consist of bank statements.
Right.
We might have some old ones on file because that's what we pre-approved you with, and now we got to freshen those up.
Right.
Same goes for pay stubs. If you have pay stubs included in your income structure, then we're going to have to freshen those up.
Perfect.
But for the most part, we can enter into application within a day or two.
Okay.
And get you submitted. That process of submitting a loan is what kickstarts the whole process, including appraisal order, title order, and typically within 10 days we should have your appraisal and your title back.
Okay.
Our loan commitments, loan approvals usually take a day or two at the most. So we can accomplish a good timeline and have a loan close within 10-15 days. We've done it numerous times.
Yeah.
But definitely good teamwork between the buyer, the real estate agent, and their lender is what gets us to the finish line the fastest.
So my next question was, so they can get it done in 10 to 15 days, but I believe the market average right now is between 21 and 30. So, when working with the right team, you can get it done faster, and it's really dependent on them as well, how fast they get you the documents and everything else, correct?
Definitely. And, speed isn't the only thing. It's also being stress-free.
Exactly.
It's a paperwork-heavy process, and we want to make it as seamless and streamlined and non-stressful as we possibly can.
Perfect.
So it's not just speed, it's also being stress-free.
Nice. So I know that you mentioned this, and one of the things that happens during the process is an appraisal. Can you explain exactly what the appraisal is?
Sure. So an appraisal is a legal form. It's performed by a licensed individual, and it's basically there to let every party involved in the transaction know what the property's worth.
So evaluation.
Typically, an appraisal takes anywhere from 2 days to a week, and it's all part of our process. We order it, we analyze it, we send it back to the consumer when done, and it's the basis for the transaction as far as value is concerned.
Okay, so here's my favorite part, and this is why it's so important on choosing the real estate professional, the advisor that you're working with, because what happens if the appraisal falls low?
So if the appraisal does not meet the contract price, depending on the situation, whether there's seller contribution on the table, there's a number of different things that would bring the transaction back to a renegotiation stage.
Right.
And you guys renegotiate the contract.
But on your side, basically, the bank only lends, if I have it correct, up to what it appraised at.
Correct. So the bank will lend on the lesser of the two, the appraised value or purchase price. Okay. So loan to value numbers, 3% down, 97% loan to value. We're going to be basing that on the lesser of purchase price or appraised value.
So, and the reason that I say it's so important for you guys to choose the right professional is because, the agent or the broker that you're working with, when you're placing an offer, should be looking at the comparables. They should know that the property is not going to come $30,000 below what you're offering, because the seller might not want to bring down the price. You might lose your seller contribution that was helping for closing costs, and now you have to scramble to get more money. So many things can go wrong with that little detail, and I think that's one of the biggest issues once you place an offer. Definitely.
Evaluating a home is a art. It's not a science.
It is.
You will get different numbers from different individuals. A good real estate agent, even though they're not an appraiser, should have the good skill set
to narrow down
what a value should be coming in at, and doing that's very important early on, because you could be wasting a lot of time placing an offer on something that's simply not worth the money.
Right. Okay. So let's get into, and this is the last one, so I don't take up too much of your time. So I know you're a mortgage broker. What exactly, can you explain what that means and why that's different, or how that's different from working with a bank?
Sure. Good question, actually. So working with a bank or lender, you're kind of stuck in one item, one product. They have different loan products, but they're, it's whatever they offer.
Right.
We are brokers at Syntax.
Okay.
And the reason we're brokers at Syntax is by choice. We like to have a nice suite of different bank options,
right,
and loan options for our consumers. We have very little overlays or rules when compared to banks or lenders. And another reason we like our licensing model is because we pass on a lot of savings to the consumer. Our interest rates are phenomenal, and for the most part, it has a lot to do with margins. We work on a slimmer margin, and we pass the savings on to our consumers.
Perfect.
Agility and speed to closing is also something that we are proud of.
Right.
Our process is very streamlined because we have big engines behind us. Underwriting engines, your loans are approved in an hour versus days or sometimes weeks.
Yeah.
So definitely agility and savings is what we are proud of with our broker model.
Perfect. And let me ask you, would you recommend someone who's outside of South Florida, for example? I know you do the whole state of Florida for lending, but someone that's in another state, would you still recommend them to go to a mortgage broker, or should they go to their local bank? What's your opinion on that?
Well, if you're buying in the state of Florida and you live elsewhere, definitely give us a call because we're going to be able to help you here in the state of Florida.
Okay.
So you can call us. You can call us whether you live in Florida or you live out of Florida. If you're buying in Florida, we can help.
But what about the people in other states, just for an example? Because I know people are going to be watching this from everywhere. So
for the most part, we're all pretty much working by the same rules in every state. So I really feel that the broker model is the model that best suits the home buying industry.
Right.
We have a nice connection with the real estate, soldiers on the ground, and our model is a very agile model. I think anywhere, any state you are, a broker is a good way to go.
Perfect. So if you guys are in Florida, give George a call, and if you're not, look for the mortgage broker instead of going to your bank.
Definitely, banks have a lot of overlays, and they don't have a good connection with the industry.
Perfect.
Sorry, banks.
So, thank you so much, George, for joining me today. I hope everybody feels well informed after this video. Please make sure to click there and subscribe, and
definitely
be sure to check out our future content.